Hi, everyone. Thanks for joining us today. Today, we've got a special guest for you. We've got Joseph Sanchez from Sovereign Lending Group, and he's going to be talking with us about recasting. Let me get him on the stream with us. Good morning, Joseph. How you doing?
I'm doing well. Thank you for having me on.
Yeah, no, thanks for joining us today. Uh, so Joseph's a 30-year veteran in the industry. We've had him on before on our podcast, and today, the other day, him and I were talking, and he mentioned the word recast. And I had never heard such a thing regarding a loan. So that's why we invited him on today. I thought it'd be great if he could explain that to us. Maybe we'll talk about interest rates and maybe other things that are going on in the market. And maybe Joseph, if you've got anything else to share with us, we can go into that too. So again, everybody, really appreciate you joining us. Don't forget to hit the like and subscribe button for us too, just to show your appreciation to Joseph also for joining us today. And we'll also put his information in the links below of the podcast as well. So anyway, let's get into it. Joseph, so explain to us what is recasting?
Okay, so I like to tell stories and scenarios. Okay, so had a client a couple of years ago, especially when the market was different, right? So we couldn't have we couldn't have contingent offers, and so had a client out there that went ahead to Israel and he had put 10% down, but he had a house to sell.
Mm.
And so what the strategy was after he went ahead and sold his house, we had what we call a recast option. Some lenders will have it. It can't work on every loan. It does work on conventional. From what I'm gathering, it doesn't work on FHA or VA, but it also works on some jumbo loans. But basically, what the theory, well, what it was after he sold his house, he had about $300,000 worth of equity.
Mm-hmm.
So what he was going to go do was he was going to go ahead and put it towards his principal. If he didn't do the recast and he just did a principal reduction, he would shorten the term, but the payment stayed the same. And so with this recast strategy, basically we had to make sure that he made 12 months worth of payments, which he did on time.
Mm-hmm.
Also, the lender that I was working with had a $350 fee. So he had to make sure that he paid that fee. Then what happened was when he took that $300,000 and he applied it towards the mortgage, his payment actually dropped. His payment dropped to where it would have been if he was able to put a larger down payment. And so as I'm talking to my clients now, especially the ones that do have these lower interest rates,
Mm-hmm.
if they want to take advantage of creating more wealth by paying down some principal, if they have a minimum $5,000, I'm recommending that they go do a recast. So this way, because I have one client that's been paying an extra a couple $100 a month. They got a bonus, and so now what they're going to be doing is that they're going to recast. So they got a hold of the lender. They're basically going to be sending a check for $10,000. And so the following month, once that $10,000 hits and everything's okay, that payment drops. So it was a better strategy, because he doesn't want to refinance. I mean, shoot, his rate is up below 3%. And that makes sense.
Perfect. Okay, gotcha.
Now, in my particular case, I'm not recasting it, but I'm able to remove my mortgage insurance because I have that equity growth.
Mm-hmm.
And so now I'm getting ready to save $175 because basically what I did was I reached out to my lender and said, I believe, that I have the equity there. I've been making my payments for 2 years.
Mm-hmm.
I just ordered an appraisal that cost about $350. They're going to be coming to do an inspection on my house, and I'm about to drop $175 off my payment by being able to remove the MI.
Wow. So
Okay.
did you hire the appraiser, or does the bank send an appraiser?
The bank is sending the appraisal.
Okay. So you call them and say, hey, you know what? I think I've got enough equity in my home. I'd like to drop it. So that's actually a good point too to bring up to anybody that's got some equity. So just to recap the recast thing then. So in the past, if I was to make extra payments on my loan, what that means is, so I make my mortgage payment, it's X dollars per month. Let's say I make an extra $500 payment to it. It doesn't change my payment next month, right? Like I have to make the same payment no matter what. Even if I put 1,000 extra, 10,000 extra, 300,000 extra, my payment will still be the same next month, right? So
Absolutely.
recasting, if I'm understanding it doesn't make my payment the same the next month. The bank will completely reconfigure my loan for the remainder of the loan. Is that how that goes?
Correct.
Whatever the balance is for the next. So if I have 10 years left on my loan or 15 years, they'll redo it for the next still 15 years, right? It doesn't go
Correct.
into 30 years or anything.
Correct.
Okay, perfect.
But the whole idea behind that, though, is your payments dropping, right? Because, like, for example, if you had an equity line or an adjustable, when the balance goes down, your payment's based off the remaining balance.
Gotcha.
Okay, so on the fixed rate, if you do principal reduction, you're basically creating extra equity, but you don't see the payment dropping.
Yeah, because I guess intuitively we all expect it, right? Like, okay, I made an extra payment, like my payment should drop, right? Because I guess we're thinking of it kind of like the HELOC type of a process. Okay, gotcha. Yeah.
And then I do have a really cool calculator that I can show you.
Okay.
And to where I can, like, for example, I have a client that's going to pay an extra $250 on their mortgage. That's going to save them about $37,509. And they're going to pay it off 5 years earlier, but the payment stayed the same. And so, they don't have that one-time $5,000. However, their goal now is, because now they understand the power of the amortization table, how to take advantage of it. What they're going to be doing now is putting an extra $400 a month. And when they get their bonus next year, they're going to go ahead and recast it one time.
Gotcha. And you said there's a slight fee for recasting, right? So it's not like for free, but
no, but it's also a lot cheaper than refinancing your house, right? So it's just a great way to grow more wealth with your real estate.
Gotcha. No, that's good. I like it. I think it's a great option. I had never heard of it before, but it's something that we all expected if you were to make extra payments, but we just didn't know what to ask for. So again, this is just another good point of whenever you've got questions about your loan, and here I'm a realtor, and I've never asked a lender about that, but this is a good lesson for all of us. If you ever have a question about your loan or how things work with your mortgage, always call your lender and ask the question, because they can always help you navigate that, or at least get the ideas out there so what you can ask, or maybe what you can or can't do. So it's just getting informed, and that's why I loved it when you mentioned it, and I was like, okay, we got to talk about this, we got to share this with everybody. So because I'd never heard of it mainly, so, and it could just be me being naive about the whole process too, but no, thanks for sharing that. I love the idea too of reminding everybody to check with their banks. If you've had your home, most people, if you've had your home the last 2 to 5 years, you most likely have, and you have PMI, you most likely are in a position, like Joseph said, to go through and talk to your bank and say, hey, you know what? I think I've got more than 20% equity in this house now. So can we reappraise the house so they can get my PMI removed from my loan? This is a great time to do it. So don't worry about the market shifting or anything like that right now. You would still have plenty of equity, even with the slight softening that we've seen in the market.
Correct.
Yeah, good. So again, just to get that PMI done, is there like a place you go to FHA for that, or VA, or
well, okay, so let's talk about the FHA. So the FHA, that mortgage insurance is going to be on the life of the loan pretty much if you came in with a minimum down payment.
I see.
VA does not have any mortgage insurance. It has a funding fee. And so really the best strategy is that if you have that conventional loan, then you can remove that mortgage insurance, but minimum, it's going to have to be on there for at least 2 years. Going to have 70%, 78% loan to value, have to make your payments on time. And then you have to call your servicer though. So whoever is collecting that payments, they're going to be the ones that they're going to be able to give you exactly what you need to do.
Perfect. Okay. Excellent. So again, just about asking questions, right? So just calling the servicer and getting that done. So perfect. Yeah. So let's talk. I'm going to switch the subject here. What's going on? Unless you had something else to add on recasting.
Well, let me show you real quick that quick calculator.
Oh yeah. I'm sorry. Yeah.
If I share my screen with you.
Yeah, go for it. I think it should let you, right?
Yeah. So let me see. It should. Let's go.
Yeah. Thanks for reminding me about that.
Share screen. All right. Tell me if you can see my screen.
Okay, not yet.
Okay.
All right, now I can add it. Here we go.
Okay. All righty. So this is where, if you were to go ahead and just do a regular principal reduction, you see how $250 per month based off this person's scenario.
Trying to get rid of that flickering.
Okay. He's basically saving about $37,000. If he was to go ahead and let's say put $400 a month, he's saving about $54,000. And he just, let's see, by making those payments, he just paid it off about 7 years earlier. And then you talked about doing, let's say, $1,000 a month, about 12 years earlier. But what's happening with this scenario, the payment's staying the same versus recasting.
Gotcha. Yes.
Okay,
So his term will go shorter, 12 years earlier, but his payment stays the same. So if you can afford the payment and you're looking to maybe retire early or finish paying off the home earlier, that's the way to go. But if let's say you've got the money and you just want your payment dropped, then recasting is the option. Then it sounds
absolutely.
like.
So there's pros and cons, but I really don't see the con with the recast. So I like that feature, especially if I'm wanting to create that extra equity wealth and because that's the power of amortization and future principal.
Yeah, no, I love it. That's great. That's great. Yeah, thanks for going over that. Perfect. It's nice to see the visual too. You can really see the difference there. So how are interest rates today? We've been hearing about it. We've been seeing them rise.
Oh my goodness! So
where are we at today?
Saying that question. Okay, so right now the bond market's not liking it. They're not liking what the feds are doing. They're saying that they're losing control. Okay, let's translate that. Rates are going to go up a little bit for sure. Yeah. I don't think the market's going to crash. I think it's going to right size Israel, but also too with these interest rates. This is why having strategies, getting into these mortgages now, and really understanding, okay, why am I buying, and what are the opportunities today? Because yes, the rates are higher, right? But there's still opportunities out there. So I'm watching rates, rising from 5 to 6, 6.5. We're probably going to be at 6.5 today. Who knows? But from what I'm gathering right now, the bond market is not liking what the feds are doing.
Right. So we're not going to see the opposite of what we saw in early August, where the feds raised the rate, but mortgage rates still came down because the lenders were still wanting to keep rates lower.
Well, we do need to slow it down, just a little bit. I do have a bold prediction, and it's not my it's not my prediction. I'm going to be going off of the experts, but we really believe that rates are going to drop in the future. So I'm telling everybody, love the house, but you're going to change the rate. Because in my particular case, I've owned my house since 2015, and I've changed my mortgage 3 times. So you're taking, opportunities. And again, I wouldn't, really pay attention, too much to the noise. Yes, have a plan, but there's strategies against this.
Yeah. So rates are higher. I let's say I'm a buyer. I've been shopping since January. Okay, so I didn't pull the trigger when the rates were 3 and 4% at the beginning of the year, and because I was getting beat out by multiple offers, and I couldn't get a house, because this is a reality for a lot of buyers. And let's say the rates rose, and now I didn't qualify for the same price range, so now I'm looking at a whole different price range, and struggling with what are some options for a buyer right now? Like if I was able to get out there. And let's say I was talking to you right now, and I want to just get my house. I've been shopping since last year, January. What are my options right now to get the lowest payment I can to get into a house?
Well, interesting that you're saying that. Okay, so one of the first things people want to do is do price reductions. And so I've done the math. So a $10,000 price reduction is probably going to save you about $50, $60 on your payment. A $25,000 price reduction, maybe $140 on your payment. Okay, so one of the things that I would be doing, especially if it's priced right, and I would have a plan. Okay, so one of the plans I'm talking to clients are temporary buy downs.
Okay,
a 2-1 buy down.
A 2-1 buy down.
2-1 buy down. So I'm actually closing one right now in Seaside, California, where we were able to get the seller to provide us a $25,000 seller concession on an FHA loan.
Okay.
And what we were able to do is 2 parts. We did a permanent buy down where we bought the rate down to 4.75.
4.75. Okay.
Yes, we did. And then that cost about $9,000 because it was 1.75 in discount points.
Okay.
Okay. Then what we did was, then we attached the 2-1 temporary buy down, which the seller has to pay. And it reduced my client's rate down to 2.75 for the first year. They're going to ease into the payment 3.75 the second year. and then it's going to be at the note rate. Because remember, I qualified them at the 4.75 anyways. And so now their first year payment's about $700 less. Second year is about $350 less. And I'm hoping we're going to refinance by that time. But meanwhile, what the strategy was to take that difference of money that they're saving up front, get rid of some of their debt. So that way, if the rates don't drop, they can ease into the payment. Because at the end of the day, they can make the payment, Israel. They just had some debt that they needed to square away.
Gotcha. So, okay, so so it'd be like if I was to be shopping for a house right now, I'm getting quoted, 6.5%. Let's say you're saying, like in this scenario, we could do the buy down, get it to 4.75, which would make almost every buyer totally thrilled right now already. And
well, no, it's going to be a little higher than that because remember, rates went up.
Okay. So let's say 5.25 or something, right?
5.25, even 5.5. Okay.
Yeah. Okay. Let's say 5.5. So I'm at 5.5 instead of 6.5 or 7. So I'm now at that 5.5 rate. I'm thrilled. I got my house. We're going to go in. So this is almost like this buy down we're talking about, or this 2-to-1 buy down. I'm not going to have to make the full payment. I get it dropped for the first couple years, and then it'll go up the next year. But I'm still at my 4.75, but it's coming in lower at a 2.75. You said
correct, because you got to remember. So that buy down cost about 2 points. Let's call it 2%. So that money is sitting in an escrow account, or it's subsidizing the payment.
Oh, okay.
Gotcha. It doesn't go to the seller. It doesn't go to the buyer. Let's say that my theory is right and we get ready to refinance this house 14 months down the road. Any money that's left in that buy down account will be used to reduce the principal.
Gotcha.
So again, price drops really, in my humble opinion, doing this for 33 years now. If it's priced correctly, then we shouldn't be dropping prices. We should be looking at opportunities, because with inflation running the way that it should be, rates should be a lot higher. So even when rates were 7 and 8, back when I was doing loans like that, we were doing interest rates, fixed for 5 years, not buy downs, but actual 5-1 arms, right? So things will settle itself down. But it's
not an arm, right? It's an actual. Your rate's still going to be the 5.5% that you locked in at the original. So if that's actually a great insurance, because if rates go to let's say they hope they don't, right? But let's say they go to 10. Like you're still going to be at that 5.5 intro rate that you got in no matter what, right? So
correct,
perfect. That's actually great, and so it lets you hedge both sides almost, right? So
absolutely.
You can taking advantage of a motivated seller right now, getting that buy down, that 2-to-1 buy down, get in with a little lower payment to ease you in the next couple of years. I like that. So it's kind of a gradual.
Do you mind if I show you a quick strategy?
Yeah, sure. No, go ahead.
Let me share my screen with you, okay? Because, and again, this is a 2-page. I'll go through it very quickly, but I believe that after I walk you through this, Israel, this is going to be some great information, okay? Because a lot of this is a rate-sensitive product. This is why people aren't talking about it. So right now, with the rates being sensitive, this is a great time to have a conversation.
Yeah.
Okay, so let me show you a strategy that I'm actually doing now. And we're getting ready to get docs on this loan, and it's actually kind of exciting.
That's cool. So this is a real life scenario here.
Real life scenario. Okay, so
thank you.
All right. So can you see this? Okay.
Yeah, can see it fine.
Okay, so here's the strategy. Okay, so on 9/6, client came to me and they were looking at a sales price of $565. They were coming in with 10% down, FHA. And at the time, rates were running between 5.25, 5.5, no points, FHA. He was going to come out of pocket about $67,000 out the door.
Mm-hmm.
And so, and mind you, he was subsidized with a subsidized payment of $1,800. And now we're telling him we're about to put you into a $4,000 house payment. Even though he could qualify, he still had a little apprehension. Mm-hmm. He was a little nervous, right? Mm-hmm. And so then I started explaining to him concessions. He's like, what's a concession? Anyway, so this is something that the seller, can pay. And then there's formulas on it. Because I knew that there was an FHA, I can go as high as 6%.
Wow.
So on the 3% concession, that was worth $16,950. And I'm basing that off of a price of $565. Mm-hmm. So anyway, so we asked for the moon and we asked for a $25,425 concession, which is worth 4.5.
Wow.
So as I was going through all these numbers and I was showing them, hey, if we go with 5.25, and if I do the buy down like that, the buy down was 11 grand, because basically in my numbers here, this was the payment at 5.25, 2,857.09. But the first year we're at 3.25. So when I minus this, he was saving $607. So that's worth about 7,264.80. Same thing over here. So the total buy down was going to run about 11 grand. Anyway, so we were looking at the options. We ended up coming over here and getting option number 4. So on option number 4, we bought down the rate to 4.75. And at the time, it cost $9,209.68 just for the discount points.
Mm-hmm.
Now, the buy down, the seller has to pay this, the buyer couldn't. So when he looked at everything, he needed $87,000. By the time we minus his credit, he's coming out of pocket $62,000, which was a lot lower than what we were talking about over here.
Yeah, gotcha. So he's coming in with the 62. So the seller's paying the portion of it, and that's the benefit there, is you have the seller do it rather than the buyer bringing in the money. It's a better use of the money coming into the transaction.
Correct. So in summary, a $25,000 price reduction saves about $141 a month. A $20,000 price reduction, $128 a month. A $16,950 price reduction is $96.94. A $10,000 price reduction is $56. So depending on the size of the concession, the loan type, down payment will set the amount of concessions.
Gotcha. That's pretty cool. So really then, so if he only gets 11,000, let's say, or let's say the seller doesn't give him the full 25, he just got a couple of scenarios you can play with, but
correct.
He's not leaving any money on the table. You can use whatever, you can use it all to the max, right? So
exactly. So that's what we did. So because we still had some dollars left over, Israel. Then we used it for non-recurring closing costs. So he's easing into the payment. He's going to be able to take care of some debt that's going to be exhausted. Yeah. If it does go to 4.75 and I don't refinance him, it's still a win.
Still a win. Yeah, he's still locked in at a great rate and at a great payment that he had already qualified for. So it's not like he's going to be shocked when his payment comes up, right? Because he already knows it's going to go up. But it's not like the craziness we saw 20 years ago or whatever that was in the last downturn that we saw, which was a major one. We saw that rates just were nuts, right? So people's payments were quadrupling or tripling. So that's what caused that collapse. But here, this is already someone pre-qualified. It's not a made up number, and it's already set in stone of what the max is for him, and he knows he can afford it. And that's what he's qualifying for today.
Correct.
So
exactly.
I think it's a great strategy to really help ones get both sides of the coin, if you will. Cause whether rates go up or down, they still win. So it's truly a nice situation for buyers. So thank you for bringing that up. I really appreciate that. So yeah, no, and again, I appreciate you coming on today. Getting us the information on the recasting was awesome. Having the 2-to-1 buy down thing. That's a new scenario, I hadn't heard of. We know that everyone's going to get creative, right, to help people get through this time of transition. But that's a new one I hadn't heard. So, and then also, helping us see, what that recasting can do to a payment was pretty exciting too. On what the options are there, and then also the, getting rid of your PMI if you can. Just a good reminder there for everybody to get with your lender on that. So excellent. All right, my friend. Well, thanks for joining us today. I really appreciate it. Until next time, everybody else, Joey's information or Joseph's information will be down below. Be sure to like and subscribe to our channel. Any other questions, feel free to reach out to us. Thanks again. Take care.